value for us. If you are in management of a small enterprise, the shareholders will ask, is there any value that is created for us? So the question we need to answer, what is the finance department doing or need to do to make sure that they create value in an enterprise? And that is what we need to deal with. Everything else, when we talk of the fighting, dealing with the risk, when we talk of the investment, everything else will revolve around that. And as I have mentioned, I have said that the finance, corporate finance, is under the Department of Finance in an organization. When we talk of the Department of Finance, we will look at it from the finance manager, and there is that what the finance manager is expected to do. What is this that the finance manager is expected to do? What are the expectations of the finance manager? I will look at it from two perspectives. I will look at it from the financial perspective and the non-financial perspective. Now, the financial perspective of a finance manager is what I am displaying on the screen, and I hope my screen is clearly visible. Is my screen visible? Yes, please, are you there? Hello? I need to confirm whether my screen is still visible.
It is visible. It is visible.
Good, good, good. So yeah, okay, thank you.
I will ask if the student wants to comment, he or she will write in the comment. There is a comment section where
I can see the comment section.
Yeah.
I can see the comment section, but sometimes you can unmute and respond. When I ask a question, I want us to make it interactive. I want to make it interactive, and please feel very free. As long as it is within what we are doing, don't mind even to interfere when maybe I can explain something. I'm explaining something and maybe you need clarification. Possibly when you write, I may be on my screen and I fail to see. Just unmute and ask, excuse yourself. I will always allow you, right? Let it be interactive, and please feel free. Unmute, excuse yourself. I will always allow someone, but I'll keep checking the chat. And this is under the finance department. Number one, we talk of the investment decision. Investment decision. We can call it capital budgeting or the long-term investment. Budgeting, what is long-term investment and what is investment decision? We will get back to that. Raising finances and undertaking projects that will generate returns in the long term. When you talk of the long term, you invest 1 billion Rwandan francs today, knowing that you will not get the benefit tomorrow, you will not get the benefit after 1 week. you will get the benefits in the future. As a result of that, you need to ask yourself, what is the value of this money I am committing today in the future? And this brings the issue of the time value of money. I will commit 1 billion Rwandan francs today to generate return for this organization in the next 20 years. So what will be 1 billion today in 20 years? What do I expect it to be in 20 years? These are the questions that are answered in the long-term investment decision. So one function is long-term investment, raising finances, investing such finances to create value to shareholders or to the firm over a long period of time in the future. We will get back to that as a topic. Number two, the other function of the finance manager is what we call the capital structure decision. The capital structure decision. And what is capital structure decision? In enterprises, in corporate world, in businesses, we finance the business using equity, that is the owner's capital, and borrowing. Equity capital is that which is raised by the owners. Debt is the borrowing. But now, when you talk of the debt, we are dealing with the long-term debt. We are dealing with the long-term debt at this point. So the issue is capital structure decision involve the determination of how much should we borrow to raise capital so as to finance the objectives, the projects in the firm. The projects in number one. How much should the owners of the capital raise to finance the project in the firm? So in the investment decision, we need to raise finances. So it is upon the finance manager to guide the organization on how to raise the finances. And in raising the finances, we are talking of equity and the long-term debt, considering the issue of the interest and which combination will maximize the value of the firm. That is function number two. And the reason number two that we need to deal with the corporate finance under the finance department headed by the finance manager. Number three, what is expected of the finance manager or the function of a finance manager? It is to manage the working capital. In note number two, I said we dealt with long-term debt and the owner's equity. In note number three, we are dealing with management of the working capital, and the working capital is dealing with the day-to-day operations of the firm. We need to determine how much should be invested in current assets, how much of the current liabilities do we need. If we are to get to that point, it is under the working capital management to manage the working capital. So it is upon the finance manager to look at when we make commitment of funds in long-term projects, are we still able to run the short-term operations of the firm? And this fall under the working capital management. And I want to give you an example. We got cases in organization, and I will give an example of a university. You find that a university, and you will try to relate and see whether you can relate with an entity. A university want to grow or to expand. The board sit down and decide, we are going to buy a parcel of land. We do construction of a building so as to expand the university. This is a very common case where the institution does that, purchases the land, does construction, or even acquire property, which is a very good thing, especially from outside world. They look at it and like, oh, this institution is growing. They forget that paying the lecturers is a critical thing to that university. Paying the staff is a critical thing to that university. Having books is a critical thing to that university. So what happened? The university will make long-term investment decision at the expense of the working capital. So you find the university has very big structures, but it cannot pay its lecturers. So what will happen? When the lecturers are not paid, they compromise the education. The student will leave. So the university will be left with very nice investment long-term, but because of the working capital, the institution goes down. Why do we find ourselves in such a scenario? And yet, there is corporate finance to be studied to understand that we need to balance between the long-term investment decision and the working capital management. Where you work, any practical experience that you have, please always remember you are in the finance department. As much as we need to expert, always tell them, I am reserved, because we need to look at to balance between long-term investment and the working capital management. That is clearly explained. Number 4, the issue to do with dividend policy, the dividend policy decision. By the end of the day, they are all the stakeholders, they are all the shareholders who need to be paid. They put their money in business, hoping that at some point they will be getting something. Again, we need to balance between paying the shareholders, investing, and holding money for working capital. You can decide to please the shareholder by investing all the money in the dividends. At the end of the year, all the profit distributed as dividends. Is that business growing? You will resort to increasing the debt to grow the business because you paid equity. Instead of building the equity by retaining more profit, you pay dividends. So the other objective here is dividend policy. So we are talking of the financial functions of a finance manager. Now, I want to ask, is there anyone who has a question to that point? Either you can do it on the chat box or you can unmute and ask a question. I want us to have a interactive sessions. Someone to ask a question, please? Okay. If there is no any question, allow me to continue. I want to put it this way. These are financial, and I want to put some writing here. I say that financial functions cannot be delegated. Cannot be delegated. They are carried out in the finance department. Financial functions of a finance manager cannot be delegated. And I want to do this. I want to add here and give you what we call the non-financial functions. The non-financial functions. Now, when you talk of the financial functions, they are the ones that cannot be delegated. They are the ones that you have listed. The non-financial functions, these are delegated. They are delegated, by the finance manager to the other staff in the finance department, to the junior staff, or even non-finance staff in the organization. Such functions will include petty cash, cash management, petty cash management. The issue of the petty cash management, you don't expect the finance manager to deal with that. There is other one, cash correction. The cash correction, this includes banking, the administration, you correct cash. You need to deal with that cash. That cash need to be banked. You see, that one you don't expect the finance manager to deal with that. It is banking, handling of the cash in the organization. So those ones, we say that they are still under the finance department. We can put them as functions of the finance manager, because if they are not well managed, they will cause problems in the organization. But anytime you ask the functions of the finance manager, look at this. But it is worth noting that there are those that are delegated to the other staff in the organization. I don't know whether there is a question to that point. I hope everything is clear and I can continue. Or let me see whether someone has asked a question. Okay, I don't see anything that has been asked. Okay. The other thing that we need to understand, having an overview of the corporate finance, bringing in the issue of the finance manager and the finance department, I want us to look at when it comes to the firm, we got the various stakeholders that who would be interested in what we are doing in this organization. Why are we doing all this? Who would be interested in whatever we are doing in the organization? These are the stakeholders, and this is what I want to look at. Number one, stakeholder number one is the shareholder, and the shareholders, we say that these are the owners, They are the owners. They are the owners in the firm. They are the one who placed their money in the organization for the organization to be in existence. Number two, we have the creditors. The creditors are the lenders. They are the lenders. They give debt to the firm. Remember, we said one objective of one function of the finance manager is the financing decision, where we are talking about the long-term financing using equity and debt. The debt providers are the lenders. They are the creditors. The persons who sell on credit to the firm, they are lenders. We are responsible to the providers of finance in form of credit. 3, the employees. Every organization employee has an interest in that organization. The mismanagement of finances will not only the shareholders, the creditors, but also the employees. So the well-being of the organization, as much as they work, they will be interested in the management of the organization, and especially the finance department. I don't think there is anyone in the organization who does not interact with finance. Everyone interacts with finance, including the employees. The next one is the management. To run the organization, we got the management. And this is where now the issue of corporate finance comes in. You have the organization CEO. The organization CEO want to be seen to be working. And for us to realize that the CEO, the manager, is working, as I said, at university, the vice chancellor will be interested, the chancellor, the university senate need to be seen as working, the management. So what do? They propose big projects. But the finance knows that if we go that direction, we will bring cash flow problems in the organization. Some of the conflicts start there. So the management is interested, is a stakeholder in the firm, and they're interested in what the finance is doing. So the finance will always be in a position to give the guideline to the management because they are stakeholders in whatever is happening. The other one is the trade creditors. As I said, loan or creditors, the trade creditors, the suppliers on credit, they provide credit facility to the organization. They are interested in the well-being. And that is why when you are supplying an entity, they will tell you, that is another party that is interested. The community, the society, the community or the society. Let me say that society. We say that a farm does not operate in a vacuum. The farm operates in a world where there are other players. The community needs to reap something from the farm, creation of employment, charity, services, that is the CSR, corporate social responsibility, all that. The community is interested in that, and therefore they become a stakeholder. The other one is the government. When it comes to the government is interested in, at the end of the day, you will have to pay tax. You will have to create employment on behalf of the government or to support the government in creating employment. You are expected to comply with the law, the laws that are in place. You practice according to the law. So we say that the government is a stakeholder in the entity. The other one is the customers. When you walk to a supermarket, you would want to find that supermarket tomorrow when you are buying because you have an attachment in it. You need to get service from that entity where you get your services from. So customers are stakeholders. It is not about buying and selling. They are a stakeholder. They would wish well to the organization. So I don't know whether there is a question to that point. Did someone ask a question? What do you mean by delegate or not delegate function? Very good, thank you. I can see the question, what do we mean by delegation? I hope that one came from the functions. Thank you for that question. What do you call non-financial function? The work of dealing with the petty cash. Good, thank you. Now I feel that we are moving in the same bus. Delegation. Remember, this is under the functions of the finance manager, and I want us to go back there. We are talking of the functions of the finance manager. What does the finance manager do? There is no investment decision that will be made without the finance manager sitting in the meeting. There is no decision about, are we going to get a loan? That will be done. The issue to do with the balancing between the current assets and current liabilities us is in finance department. But do you expect the finance manager to be the one that is preparing the petty cash book, to be the one who is disbursing the petty cash? To the finance manager, it doesn't involve the finance manager directly. They are delegated to some people. When it comes to the cash correction, you don't expect the finance manager to be the cashier. They are delegated to the persons that are at different level. Sometimes they are not even delegated to finance persons. We say that they are non-direct functions to the finance manager, but they fall under the finance manager. It is not the finance manager who will do it. And that is why we say they are non-financial functions. They are delegated. They are under the finance department, but they are delegated to some other party. They don't require the input. These parties will report. But when it comes to these others, you cannot talk of acquiring a new plant without the direct intervention of the finance manager. And I think that question is the two questions related to the same thing. And I believe I have answered them. Thank you so much for those who are asking questions. It means that I'm not alone. Good. Is it necessary to always arrange these stakeholders based on the order? We cannot say who is important than the other. That is why you can just keep them randomly. Even in an examination scenario, every stakeholder is equally important. So there is no specific order. We say who is important than the other. They are the stakeholders. The pace is very low. Don't worry. Don't worry about the pace. That one I will manage. You see, we cannot start at a very high speed. At some point, we'll move at a speed. But for today, let us move slowly. The pace is very slow for the interest of conveying as much. Don't worry. Don't worry. I have all that it takes to manage your time. Is receivables during non-financial function, finance department? Yes, because it doesn't involve the finance manager directly. They delegate them, the receivables, the payables, they are delegated. So, but the question in the exam will be, in most cases, it is functions of finance manager. Deal with the direct functions, of the finance manager. Good. I think we can move to the next item. For the person asking about the speed, don't worry. I will move at the speed that will make you, for today I have to move very slowly to bring you on board. Good. The next item that I would want to do for this financial environment and the introduction to corporate finance is the goals of a firm. The goals of a firm. We talk of the goals. Sometimes they will ask you about the objectives of a firm, the goals of a firm. I will explain 3 goals or the 3 objectives of a firm. But before we get to that, I would want you to understand what it means with the goals, what it means with the objectives of a firm. If today someone gave you 10 million Rwandan francs and they tell you to go into business, you go to business for various reasons. All the reasons that will make you to invest that money fall under these 3 categories. They fall under these 3 categories. If today your organization has raised 1 billion Rwandan francs and you are required to advise them on how to commit the money, you will go the investment in either of the 3 reasons. So the reason that an investor put money or a business person commit finances is either profit maximization, wealth maximization, social responsibility. I want to start with the profit maximization, and I will say that it is a short-term goal. The short-term goal, this is the one that is pursued by starters in business. If you are going to business to raise money so that you can get money to pay the school fees of your kids, to pay rent, to meet your day-to-day expenses, that is for profit maximization. Short-term goals to raise income for consumption. It is a short-term goal that is aimed to raise income or to make profit for the purpose of consumption. We say that it is a profit maximization. You want to make as much as you can so as to have a good livelihood. It is a profit maximization goal. Now, what are the challenges of this approach? So I can put challenges of this approach. I'll say number one, ignores time value of money. It ignores the time value of money. It doesn't put into consideration the time value of money. What do we mean by the time value of money? It is concerned about how much did I make today? I need to spend. By the end of the month, I need money to pay for my rent. You see, it is about now. It is not concerned about the future. Number two, ignores the going concern of the business. It ignores the going concern of the business. When you look at the people pursuing profit maximization, the very small business that we have, MSMEs, they are about how much do I make? They are not concerned about what will my business be in the next 50 years, in the next 10 years, in the next 20 years. It ignores the time, the going concern. It is not about the future. And that is why when some of these businesses, when the person who started them is not there, the business just go down. They die when the person who started them is not there. Profit maximization. And I want you to understand it because the examiner will tell you to explain profit maximization. Now, allow me to get to the next one, which is my number 2. And this one is wealth maximization. This is what we call creating value. Creating value for the shareholders. The creating value for the shareholders. And what does it mean by creating value for the shareholders? We are concerned about, at the end of the day, we will look at what was the value of our business at the start and what it is at the end. It is about value creation to the shareholder. It involves reinvestment of the value that is created, of the income that is generated. Once you make profit, the profit is reinvested to create value so that in future you can make more. Now, this approach is good because, number one, it puts into consideration the time value of money. So the strength of this method, of this approach, is that it puts into consideration the time value of money. it puts into consideration the time value of money. Like at the end of the year, when you're presenting your financials to the shareholders, you will tell them that our farm is this worth. Then 1 year down the line, you will tell them it has grown to this much. In the next 10 years, we expect it to grow to this much. That is number two, strength number one, or advantage number one. Advantage number two, or strength number two of the wealth maximization, it puts in consideration the going concerned. So it is concerned about the going concern of the farm. Concern of the farm. It is concerned about the going concern of the farm. What will the farm be in the future? Is the farm there? The farm is there today. What is its future? Are we going to have this farm in the future? When you look at all the companies that are listed in the Rwanda Stock Exchange, they have been there for years. They will be there for years. Look at multinational companies like Coca-Cola, Microsoft. They have always been there. Whether the owners are there or not, they will still be there, the going concern. So when you are told to give the strength of the wealth maximization, is that they are concerned about the going concern. Weakness, that is the challenge. The challenge. Weakness of this method, it ignores the time value of money. Sorry, not the time value of money. It ignores the social responsibility. Social responsibility. It ignores the social responsibility. And I want you to understand this. When you look at the world that you are living, we are living the world of capitalists. Capitalists, not socialists, capitalists. These are people who will make billions of money while their neighbors are sleeping hungry. Why? They want to create wealth. They are about wealth creation. So the problem of this goal is that it is more inclined to wealth creation than it is on the society. That is a very big disadvantage of this goal. And a majority of the people, when they get out of profit maximization, they think about creation of the wealth and they forget about the humanity. So it ignores the social responsibility. And as a result of that, I go to the last point. It is the social responsibility, the well-being of the society, The well-being of the society. An organization will make profit and ask, how much have we reserved for our employees? Can we increase salary, the benefit to our employees because we have made more profit? Can we do corporate social responsibility? We'll be looking at that. The corporate social responsibility, the social responsibility goal. So you find that most of the organizations, as a matter of society consideration, they do the social responsibility. They set aside some money to help the society. It should not only be from that perspective, but to look at all the stakeholders, the employees, the customers. There are organizations that will even call the customers, the major customer, they reward them. It is a society. They will be concerned about road construction, giving back to the society. When you are told to give the objective of a farm, it is profit maximization, wealth maximization, social responsibility. I think I have explained that. If someone has a question, Please ask as I check whether someone asked a question from this end. Okay, I haven't seen any question. I don't think anyone has a question on the goals or the objectives of the farm. If there isn't any question, if there is, someone can ask. I know that one we are not getting back to it. I will only get back to it when I see a question in the past paper and I tell you to explain to see whether you understood what came of us. Good. Allow me to get to the next point. The next point I want to explain the agency theory. The agency theory. When you talk of the agency theory, we need to try and understand what is agency theory in corporate finance. What is agency theory in corporate finance? And one thing that I want to bring to your attention is that an organization will not grow without agency. Agency interests without agency. And when you talk of the agency theory, it is as a result of two parties. One party is the principal and the other party is the agent. A principal delegates to an agent. The agent executes on behalf of the principal. Let me give an example. Shareholders are the owners of the firm, but they may lack the expertise to manage the firm, or they may be committed with other assignments and other responsibilities that they cannot manage their firm. As a result of that, they are forced to get experts who will manage the farm on their behalf. To that end, we create an agency relationship. The principal is the shareholder and the management are the agents. They are doing it on their behalf. The reward for agency is consideration. There is something that they will get in return of that. So when it comes to the principal, they delegate to the agent expects something in return. That brings the issue of the agency theory. But what is important at this point is, one, to understand what is this agency, and number two, to look at the various issues that will arise when it comes to the agency theory. And having given an overview of the agency theory, I want to give you the examples of the agency relationships that exist in business. There are countless, there are many. I will try to explain a few, but having the explanation, if you are faced by any, even the one that we may not mention, you will be able to relate. And the issues to do with the agency relationship, I want to give an example. I hope you can see my screen. Some of the agency relationship that we have, we got number one, shareholders and the management. The shareholders and the management, we say that shareholders may not be in a position to run the business. They appoint professionals to run the business on their behalf. In return, they pay the managers. That captures the employees and every other person. Two, shareholders and the creditors. Now, when you talk of the shareholders and the creditors, we say that lenders are the principal. The lenders are the principal. Okay, look at it this way. If today you walk to the bank, you borrowed some money. that money belongs not to you, but to the bank. So the bank expects you to manage the money in a way that you will be able to repay the loan. At the same time, you will be able to repay the interest. So we have such a relationship. The money belongs to the creditor or the lender. Shareholder representing the firm manages the money belonging to the lenders. The other one is shareholders and the government. The government is the principal and the shareholders are the agents. How is that? If it were possible, the government would be the owner of all the businesses to create employment, would be the owner of all the businesses to provide services to its people, would be the owner of businesses so as to provide services. But the government is not capable of doing that. It does not have that capacity. It got a lot to do. Hence, it allows investors to do it on their behalf. So the investors or the shareholders will run the business. They pay taxes in return. They practice fairly in return. So the government holds shareholders accountable for their action. So the government is the principal, business or shareholders are the agents. The other one is shareholders and auditors. Now I want to ask a question. In the shareholders and auditors, can someone write on the chat box and tell me who is the principal and who is agent in the shareholder and auditor? As I look at a question, I can see this question has been asked. As you respond to my question, between the shareholders and the auditors, who is the principal and who is the agent? There is a very nice question that has been asked by someone. The question reads, what company gain from CSR as an objective? That's a very nice question. In the real world, even in the exam, I want to put it this way. I want to give an example. I'm sure you know this company, the Equity Bank. We have Equity Bank in East African community. I think all countries have Equity Bank. Let's talk of Equity Bank because it is an East African community bank. When you look at the Equity Bank, they have a program they call Wings to Fly. Wings to Fly. They help the people from their assessment. They feel that they are bright students, but these students may be unable to meet their academic desires because of unfortunate background. So what they do, they will go to schools, they pick those kids, educate them, help them in all that they can. In return, what does the Equity Bank get? Number one, they get a very committed clientele base. People who feel that this is our mother, this is our father, Equity is our parent. The society feel that when I'm banking with that bank, there is something they are giving in return to the society. So what do? Let me stick by this bank because they give back to the society. Look at the Bank of Kigali. They create employment to the people of Rwanda. That employment they create makes the society to feel that this is one of us. So let us bank with them. Let us give them business. So the corporate social responsibility create a society that feel that they belong to the organization. So there is a benefit. I sometimes feel that it could be taken as a marketing strategy and it help the companies to be recognized, and it is a very good way to get to the people and again to be recognized by the people. Now, I want to go back to my agency relationship. My question was between the shareholders and the auditors, who are the principal. I can see auditor is agent and shareholder are principals. Thank you. Shareholder is principal, auditor is agent. Good. Auditor is agent, shareholder is the principal. Good, good. Auditor is agent, shareholder is the principal. Good, perfect. I think everyone answered that question correct. And we know that the auditor is the agent because shareholders may not audit the operations in the organization of what the management is doing. They engage the auditors to do it on their behalf. So the auditor become the agent, shareholders become the principal. The other one is headquarters and the branches or subsidiary. A headquarter delegates to the subsidiary to carry out some activities on their behalf. So the branch is the agent, headquarter is the principal. Now, having gotten to that point, I want to take you to the next phase. And this is where we deal with each at a time. And as a result of that, we'll be looking at the conflict that arise when we talk of the auditors and, sorry, not the auditors, the principals and the agents. We look at what is the relationship and the conflict that may arise. In case of a conflict, how do we resolve the conflict? This is a question we'll get in the exam. The examiner will tell you to explain the relationship that there is between shareholders and the management, explaining the relationship, possible conflict, the resolution to the conflict. Because the conflict will always be there, but we need a way out. So we start with the first one, shareholders and the management. As we said, shareholders are the principal, management are the agent. When it comes to the issue of the shareholders and the management, there are issues that arise. And we, in the relationship, we need to ask ourselves, what conflict come in when there is a relationship between the shareholders and the management? I will explain a number of them. This is a common area, so I'll try to exhaust it to the best of my ability. Number one, the problem to do with the incentives. A manager is hired to learn the business on behalf of the organization, and this is aimed at creating the wealth for the shareholders. The shareholder will leave everything to the employees, to the managers, and expect the managers to create wealth. Where does the problem come? It comes from the incentive point. A manager or the managers or the employees are supposed to be compensated. In most cases, employees are given a fixed pay. That fixed pay may demotivate, or the employees or the managers may feel that we are doing too much to generate a return. So what is the way forward? The shareholders feel that we have paid them. The employees feel that what you are paid is not enough. So they pursue other interests to the detriment of the shareholders. So one problem comes on the incentive, the compensation of the managers when it comes to the issue of engagement. The other conflict comes that is from the incentive, the other end. We call it the consumption of prerequisites. And what are these prerequisites? Sometimes the managers, in the attempt to compensate themselves, they overspend on themselves at the expense of the shareholders. For example, the manager is paid a fixed pay, but they create a room for allowances, the per diems. You see, they will sit and say that if I work overtime, I will be compensated for that. So what do? They do their work under the normal working time, but they make sure that they leave something for the overtime. Then these overtimes are expensive to the firm. They will try to get the much benefit from the organization, having big cars for the CEO at the expense of the shareholders than it is required. I'm very sure you have seen this in the government, where you feel, why are we investing too big cars for the government employees? Why can't we give them moderate? It is at the expense of the shareholders, who are the citizens. The same case happened in the corporate world. The CEO has everything: holiday paid for by the company, lifestyle catered for by the company, and this is at the expense of what would go to the shareholder. So the shareholder may feel that this is too much, and that leads to the conflict between the shareholder and the management. The other thing is the difference in risk profile. There is a different perception towards the risk between the managers and the shareholders. And I want to ask you a question. Let me remove that one. Let me ask you a question, and I want you to write here, between the shareholders and the managers, who are risk takers? Between the shareholders and the managers, who are risk takers? Please put it on the chat box as I check whether there is anything else that has been written. Between the shareholders and the management, who are risk takers and who are risk averse? Who are risk takers? Who are risk averse? I want a number to write so that I can look at what you've written. Between the shareholders and the managers, who are risk takers? Who are risk averse? Thank you. I can see the response. Okay, let us read the response. Shareholders, I believe you are saying shareholders are the risk takers. Shareholders are risk takers. We have another one says that managers are risk averse. Thank you. Shareholders are risk takers. Yes, that is how it is. The shareholders are the risk takers. Managers are mostly risk averse. Shareholders are risk takers. Yes, the risk takers are good. Thank you. Now, where does the conflict come from? Shareholders being risk takers and the managers being risk averse. The risk comes in, the managers are reserved to the risk. Why? Because they just want to play within a manageable element. They know that if they mess up, they will be held responsible. The shareholders, on the other hand, know that risky ventures are more profitable. High risk, high profit. High risk, high profit. That is why the shareholders will tell you, try to do a venture in a country where you know that you can make high profit. Let me give an example. If you look at the East African community, there are 8 countries. Rwanda is a less risky. Overview, the population of Rwanda is about 14 million. Maybe if you don't know how big Rwanda is, the population of Rwanda is approximately 14 million. The landmass of Rwanda, for your information, is 26,000 kilometers square. 26,000 kilometers square. Maybe someone never knew that. Kenya population is 55 million with a landmass 581,000 kilometers square. So we are talking of Kenya is about 20 times bigger than Rwanda. Population 55 and Rwanda population is 14. Let us go to DRC. DRC, they have a population of about 96 million people with a landmass of about 23, that is 2.3 million kilometer square. You see, Kenya is 581. Rwanda is about 2.3 kilometer square. Rwanda is about 26. And Macube, the population of DRC is only 94 million. The population is very high. 2, the natural resources in DRC are so many. So, but the insecurity in DRC is the highest. So if you go to DRC, because of the high population, high land mass, a lot of natural resources, you are likely to make more money. But now, the risk. So a shareholder will tell you, open a branch in DRC. But for you as a manager, you will look at it and say, no, the risk is too high. I don't want to risk. What if the business go down? I will lose my job. The shareholder will say, I will only lose my investment. I will only lose my investment. I can borrow money and invest. If the investment go down, I will not lose the money I invested in the loan because the loan does not belong to me. It is granted to the business. So there is that conflict. The shareholder wants you to invest in the risky ventures so as to make more profit. But managers feel if we lose, they will lose their business. They will lose their employment. They will tarnish their reputation as managing an entity that went down. So that conflict is another problem between the shareholders and the managers. So it is good to look at it from that perspective, the difference in risk horizon or the risk profile. The next one is different evaluation horizons. This is another thing that causes a conflict between the shareholders and the managers, the difference in evaluation horizon. Managers want to undertake projects that are profitable by the end of the year, because the managers want to present financial statement and say, at the end of this year, we made this much profitability in the short run. So they might do things that will bring profit closer at the expense of the future. Shareholders, on the other end, they are concerned about the going concern of their firm. So what do they want? They want long-term investment that will create wealth in the future and guarantee their business in perpetuity. So the evaluation horizon causes the conflict because the managers feel they need it now to be considered as performers. The shareholders feel that they need the going concern of the firm. So that causes a conflict between the shareholders and the managers. The other conflict that arises is that of management buyout. We've seen cases where the managers, the board of management, try to come up with ways that will enable them to get ownership, to acquire the firm, to get it from the shareholders. This is not a single occurrence. It is not twice. It is something that is in many organizations. Even the small businesses, you leave someone with your business, they want to turn it to be theirs. So the management buyout, it is that attempt by the management to get the ownership of the business belonging to the shareholders. So if there is anything that they can do to have the business acquired that will interest them, that will benefit them, they go for that. That causes a very big conflict. Sometimes we've seen where a shareholder loses business and the business is taken control by the managers. They can even initiate a process of selling the business while they know very well that they will end up being the owners of the business. The other conflict that arises between the shareholders and the managers is pursuing power and self-esteem goal. The managers want to undertake ventures that will make them to become big guys. For example, the managers will influence an acquisition or merger so that they can control a big entity. On the other end, the shareholders want to retain the control of their firm. So that causes a conflict because managers want to build a big entity. They would want merger. And you know, when you merge, shareholders, different shareholders come. The manager benefit because they become manager of big entity, but shareholders' control is diluted. The other thing that causes conflict is creative accounting. We've had countless issues where management in organization prepared the financial statement to their interest at the expense of the shareholders. The creative accounting, preparing the financials that will benefit them or that will show that they are performing. And one of the scenarios that is very common is twisting the accounting policies to suit the managers, and the accounting policies make the financials look good. For example, we can have a depreciation policy that can favor the management. For example, if we did a reducing balance depreciation, the depreciation decreases over time. So when we charge depreciation as an expense, we charge less expense in the income statement. But if we had a straight line, the depreciation would remain high. So the the change of depreciation policy to reducing balance can make the expenses to reduce over time. So even if the management is not efficient, they can reduce expenses by using reducing balance that is favorable to them. So they will look like they are making profit while it is the depreciation that is going down. So I am just giving an example of how you can change the policy. There are so many other ways in which you can play around with the policy in the organization to suit you as a manager at the expense of the shareholder, or to show the shareholders that you are making profits while you are not performing well. Creative accounting. I don't know whether there is a question on that. Ask a question. Let me check whether someone asked a question. Okay, I cannot see any question. The last one is the answer to what I had asked earlier. Good. I believe you are moving on well. Yeah, we are moving on well. I want to give you 5 minutes to stretch. Take a glass of water. I will give you 5 minutes. 5 minutes. Just take a glass of water. Then we will continue from there.
Kanguriye se akaba yaho akaba nkubye nk'akamiliyoni yakemura ibibazo. Abantu ndimo amadeni nkagura n'agakapu. Nayagira ute? Mama ari mu nzu. Ugiye he? Genda umurebe mu cyumba. Ngwino mukwereke. Genda umurebe mu cyumba. Genda umurebe hariya mama. Enye. Wapi ariko nta. Aho warafunze.
Good. I think now we can continue. Are you there? Yeah, I hope we are there to continue with the last session, last phase. Let me get back. Good. So, we are still looking at the agency theory. And what we need to look at, we've seen what causes the conflict between the shareholders and the management. I want us to look at the solutions that may come on our way when we are trying to solve the problem of this conflict. What alternative solutions are there to such conflict? Number one, performance-based compensation. Let me find out. Can you hear me? Let me know whether you can hear me, please. Please. Can you hear me? Yeah, we are hearing. Okay. Yes, we can. Good. Thank you for that. I want us to move to the next part, and this is seeking the solution to the conflict between the management and the shareholders. Number one is performance-based compensation. Because of the conflict that arises between the shareholders and the management, the shareholders may decide to remunerate the employees or the managers on bonuses. But now we say that there is a basic pay plus performance-based commission or bonuses. So you cannot hire them. The shareholders should not go for the hiring, giving them only bonuses or commission. They should be paid a basic pay plus the commission. That is number one. That will make the managers feel that they are recognized for what they do. Number two, the threat of firing. Firing in a competitive world that we are today can be a challenge. You lose your job for poor performance, it will not be easy to get another one. So the threat that you'll be fired is one thing that has made many people to work. Actually, a majority of the people work because they fear to be fired. And even when you're in conflict with your employer, after all those warnings, the last thing is that let us fire you. So that fear of losing a job, that fear that a manager will lose because of failure to perform is something that can tarnish their reputation. Threat of firing. The next point is the threat of hostile takeover. It reaches a point, or it gets to a point where the managers may feel that if you are not ready, if you are not able to manage this farm, why can't we sell it off? Why can we have it taken by someone else? And you know that when the farm is sold or is given out, is taken over, the predator is the entity that takes over. In most cases, they come with a management team. So you are likely to lose a job when you know that other performance will value the farm, and the farm will be acquired. So in such a case, you will always manage the farm so as to protect the hostile takeover or unwillingness in taking over. We will discuss that when we go to the merger and acquisition. The next thing we look at is direct shareholders intervention. Sometimes the shareholders may intervene by, number one, forming a board. The board constitutes of the shareholders. They will be foreseeing the day-to-day operation of the business. Number two, they can intervene in an AGM by proposing a removal of a CEO, of a manager. So they intervene. They also can come and help in decision making in an organization. So we talk of a direct intervention by the shareholders. That is the other thing that can solve the conflict. If the managers feel that they are unable to learn, or there is a lot of conflict with the shareholders can do a direct intervention. The other one is voluntary code of practice. This is where the manager adopts the code of ethics, the professional code of ethics. They are guided by the code of ethics. If you are an accountant, you are not learning it because of the shareholder or because you fear to be fired, but as a professional, you are trained the way you should do things right. The code of conduct guided by your professionalism, the code of conduct, the code of ethics. That is the other thing, that you get professionals who are guided. Human resource manager is a professional. Accountant, finance manager is a professional. They will learn the entity in the right way. They are guided by their code of ethics. The other one is what we call the executive share option plan, or the ESOPs. And ESOPs is where the shareholder commits or promises the management some ownership at some point if they achieve a certain point of profitability or a certain point of performance. So the managers will give the senior management ownership in the firm. So they do not run the firm only as employees. Instead, they run the firm as owners. We talk of ESOPs. And that has motivated many managers because they get the ownership. So that is another way to get into to dealing with the conflict. Make them shareholders, make them the owners. The other thing we talk of the remuneration policies. You try to motivate them through good remuneration packages. That is the other thing that can reduce conflict, because well-paid managers will always pursue the interest of the shareholders. The other thing is the issue to do with incurring agency costs. And incurring the agency cost, this is where you go ahead, the shareholders go ahead and incur costs that will help to supervise or to monitor what the managers are doing. For example, contracting legal entities who will negotiate the remuneration on behalf of the two parties. There is the monitoring cost, where the shareholders will engage auditors. They will engage M&E experts. They will invest in internal audit. So they incur the monitoring cost. They get other parties to monitor what the managers are doing. The other one is the opportunity cost. The managers are penalized for the achievement that they ought to have achieved, but they failed to achieve. So the managers, if they are risk averse, they fail to undertake a profitable project. If they do not do that, the entity will lose profit. So they are penalized because of that. Then the restructuring cost. Sometimes you restructure the business so as to implement some internal control systems that will help you deal with the management. The internal control systems help the management to carry out the objective at the interest of the shareholders. And that is what we call the shareholders and the management. Very wide, a lot, but still examinable. I want us to look at another one. We may not look at all of them because they are countless, but the thing is, this one opens up the thinking of a student to ask themselves, if I'm presented with a scenario, shareholders and lenders, shareholders and managers, shareholders and government, how can I come out with a solution? How can I come out with a conflict and the solution? So I'm trying to give it a deeper explanation because we cannot explain all of them. Now let us get to the shareholders and creditors, unless someone has a question. Let me see whether someone has a question. If you have a question, please let me have that question. I respond before I get to the next one, the next agency relationship. So far, I cannot see a question, but if you have one, please just post it. I will respond. Now, let us look at the shareholders and creditors, the shareholders and lenders, the shareholders and board holders, shareholders and bank, which is the lender. All of them are put together as shareholders and creditors. I want to explain who is a bond holder. A shareholder holds share or equity in the business. They are the owners. A bond holder or a debenture holder holds a debenture or a bond from an entity because they are lenders. They are therefore the principal, while the shareholder representing the firm is the agent. The shareholders or the firm is therefore expected to manage the firm to achieve their interest and the interest of the lenders in paying the loan and the repayment of the loan and the payment of the interest. And I want you to get it clear here where the conflict arises. Shareholders know that if the firm went down, they will only lose their capital contribution in form of equity. They, as we said earlier, shareholders are risk takers. So what do? They borrow through the company. They make a decision to invest in risky ventures. If the business succeeds, they will pay the lenders interest and repay their own only. All the other profits will accrue to the shareholders. In case the business fails because of the high risk, the shareholders will only lose to the extent they contributed in the business. Who loses? The lenders lose their money in a business that they did not have control. So the conflict arises where the shareholder knows that undertaking profitable ventures may be achieved by investing in risky ventures. And they will do that because they know if there is success, all the profit go to them as the shareholders. If there is failure, their loss is limited to the capital they contributed. And therefore, the person who will lose most are the lenders. So this is where the conflict comes in, and which we need to understand. Now, what agency relationship is there? The shareholders are the agents because they are the owners of the farm. The lenders are the principals. So what leads to this conflict of interest, as I have tried to explain, what will cause the conflict? Number one, the lenders require the shareholders to provide security or collateral. Sometimes the shareholders through their farm disposes of the collateral, exposing the lenders to the risk. And we've seen this case where a person go and borrow a loan from a bank, they give a collateral, then they sell off the collateral. So when they are unable to pay, the financial institution cannot access the collateral, disposal of collateral. That is one thing that causes conflict between shareholders or the farm and the lenders. Number two, the substitution of the assets. Sometimes the shareholders will apply, and we've seen this very common. The shareholders apply for a loan, very clear, indicating what they want to do with the loan. But when they get the money, they divert the money to some other risky projects. So they expose the business, the borrowed money more. So we got that charge of the replacement of the asset. Maybe you borrowed a loan to buy land, and the bank gave you the money for the land, but somewhere you diverted and invested in the vehicle business. Yes, there is an asset of the vehicle, but it is of high risk. Or even you interchange the security. So those are things that causes conflict between the lenders and the shareholders. And anytime we talk of the shareholder under this context, we are referring to the farm. Sometimes you'll be told farm and the creditors, shareholders and the creditors. The other one is payment of high dividend. The shareholders may feel that their farm has made profit. So instead of reinvesting to grow the farm, they pay to the owners high dividend. That make the business not to grow, and the growth is the one that will make the farm stable to repay the loan. So you find that instead of reinvesting, they pay high dividend to the owners at the expense of the future loan repayment. The other thing that we talk about is other investment. Avoiding investment in the project that the lenders provided the money to be invested. That results to the diversion of the investment. The other one is making more borrowing even before the repayment of the existing loans. So they borrow more money, they expose the business to what we call the financial risk. We'll be looking at the financial risk later under the portfolio management. The issue of making more borrowing. And this is a problem even on individuals. Someone borrow a loan, after some time they borrow another loan, after some time they borrow another loan, like they build a portfolio of debt. This one creates more problem because when the lender expects to be paid, you have a lot to pay, you are unable to pay. That causes a conflict. The lender would want you not to pay, to make more borrowing until you repay your loan. Now, when it comes to the conflict between the lenders and the shareholders, the lenders and the farm, what solutions do we have? How can we provide the solution to that? What are the solutions to this agency problem? Number one, we call it a restrictive debt covenant. We call it a restrictive or debt or a bond. Let me include the word bond, a restrictive bond, a restrictive bond covenant, a restrictive debt covenant. It is a covenant in a contract or an agreement requiring, number one, the firm should not dispose of the asset without the approval of the lender. That one is in the contract, in the agreement. Number two, the shareholders may be required not to pay dividends from the retained earnings because that is eroding equity capital. They would also be required not to pay 100% of the earnings in the form of dividends so as to have enough to repay the loan. The other point is the covenant or the agreement may state the minimum liquidity percentage. What amount of cash are you required to have at any one time? Don't invest in the long-term assets because you will be unable to repay the loan. Minimum liquidity requirements. The other one is restriction on merger or additional borrowing. The lenders may tell you, if we are going to give you a loan, make sure that one, you don't enter into merger, you don't enter into acquisitions, you don't make additional borrowing. It is a restrictive covenant in the debt management, in the bond acquisition. The other one, and when you look at these restrictive covenants, they are the ones that are imposed by the lenders even to countries. You find that IMF imposed condition, the Exim Bank imposed condition, the African Development Bank imposed condition, World Bank imposed condition to countries. They are restrictive bond covenant. They tell you, until you pay, don't borrow again. They tell you, don't borrow from some other quarters until you pay us. Let me give you an example from one of the African countries. In year 2022, Ghana fell into economic crisis. Ghana, it is a West African country, fell into an economic crisis. The government of Ghana requested the World Bank and the IMF to help them in managing their debt. And the management of the debt was to write off some of the debt because the country was in crisis. Now, under the restrictive bond covenant, IMF and World Bank told Ghana, yes, we are going to write off some of your debt, but remember, you have also borrowed from the citizens through, number one, bonds, number two, T-bills. These are the common ones. So are we going to write off the debt from our end, and you will not write off, your citizens will not write off? And that became one of the cases where the government was forced to write off debt, or the citizens were forced to write off debt, and the government did not repay loan to the citizen. And this brings a question that I would want to ask you as students of finance. Does the government borrowing still remain risk-free? An example, in Ghana, citizens lost money to their government. And you invest in the government saying the government will always pay. The government will always pay. Does the government securities still remain risk free? That is a debate that I would want you to debate among yourself and ask yourself. Try to get the information about what happened in Ghana, and you ask yourself, as a student of finance, is the government security still risk-free? The other area that we can deal with the conflict between the lenders and the firm is corroborative provision. Let me ask the corroborative. There is something we call the corroborable debt, where if you borrowed and the lender realizes that you are unable to repay the loan, or you are exposed to high risk, they will tell you to repay your loan early. In such a case, the loan repayment is called before maturity. So that provision can be put in the agreement, and you are instructed, in the event that you undertake risky project outside what you committed, or in the event you breach any of the terms of the contract, we will call you to repay the loan. This is very common. It has happened not once, not twice. Corroborable provision. When you know that the loan can be called, you will manage the loan well. The other thing is the issue to transfer of asset ownership. Sometimes the bondholders will transfer the security to some other entity. Like, let me put it this way. When you borrow and you give a collateral, like you give your vehicle as a security, you know that the bank will require that you transfer the ownership. You co-own the asset. That means you cannot sell it. If it is the land, you transfer the title to the bank. They will give you back after you have been able to repay the loan. So you cannot sell it. Transfer of ownership. Body representation. This is another area that has helped a lot in management of the debt, or securing the conflict between the firm and the debt holders, where some loans require that the lender will appoint one of their representatives to be in the board of management. Being in the board of management means when decisions are being made, the lender is represented in the board. They will always monitor what is happening. Board representation. The other point is refusal to lend or charging high interest. Another way to deal with the shareholders is to tell them we will not lend to you. Why? Because we fear your history is not very good. 2, you are given a loan, but you are charged very high interest. So as the lender can recover interest, they can recover your money early. Even if you fail to repay principal at some point, they will have earned a lot in form of interest. High risk, high interest. The other one is convertibility. This is where they can agree that if we get to some point, we will convert our loan to equity. That makes the bondholder to become shareholders. So you will borrow knowing that at some point, the loan will be converted to equity and the firm will not be in debt. That is another solution to handling the conflict. And I think to a larger extent, I have explained those points. If someone has a question, I would want you to ask as I check whether someone asked a question or something. Oh, someone said the slide is not moving. Oh, please, if you realize something you've written and need to be addressed immediately, please unmute and excuse. Someone said that the slides are not moving. I for sure they are not. I had not seen that request. Can you see the slides? You should have unmuted and requested for that. There is another person who asked a question. You mean lenders call for, oh, sorry. You mean lenders call for borrowers to pay ARE without considering what's written in the existing contract? Good, that's a good question. Whether the lenders can call, remember we have a board covenant. It is in the agreement that in the event, and I think I mentioned that, in the event you divert from what the contract say, you will be required to repay the loan fully. So they will not go outside the contract. It must have been indicated somewhere in the contract. Yeah, that's the question. It's a good question. Well, for those who could not see the slides, please, next time you note something like that, please let me know. It can sometimes happen, but now I believe they are visible. And if there is no any other question, I would beg that you allow me to leave that part of the agency. I will be doing some tests to try and give you some more of the agency, but that's a good overview. I want us to continue because there is a very important, I want us to finish with this section so that at least we can go to some other section with very important things. I want us to look at the issue of the public sector when it comes to corporate finance. The public sector, we can never ignore the public sector. Remember, we started with a commercialized perspective. And unfortunately, no one who asked me that question. The issue of what about the corporate finance in the public sector? And like where I mentioned about the objective. So the issue, I want us to look at the public sector. We call them the nationalized industries. What is the objective of the public sector? It is more of service provision and social responsibility than it is on wealth maximization. And that is the reason the government will construct roads worth billions of money while they know that they will not collect any money. They will not collect money. Why? Because they are providing a platform for people to generate income and be able to pay tax. The income is indirect. So it is more of social responsibility from the haves to the have-nots. What do I mean with that? The government will provide free education to the society that does not pay tax or pay minimal tax, because those with money pay tax. So such taxes will be paid to those who do not have through paying the education. So the government or the public sector has a more objective of social responsibility than wealth and profit maximization, although the government can also engage in profitable ventures, but the end result is whatever the profit is generated adds up in social responsibility. So the government will get into the investment. The investment is to create wealth for the benefit of the citizens, but not to pay dividends. So the government may not look at what is the value. It may not look at what is the value of this road as compared to the road in 10 years to come. It is, do we have a railway line? Do we have a road? We can have it to as long as possible, but maybe in some future, we will be required to redo it again so as to maintain it, not to gain value out of it, or not to have it increase in value, but to put it in a condition that
Sure.
it will provide the responsibility or the benefit to the society. Now, in the public sector, what is this corporate social responsibility that will also cover the corporate, as I mentioned earlier? So the corporate social responsibility, the corporate social responsibility comes more on the government and also non-governmental organization. A non-governmental organization and government can undertake a project purely for corporate social responsibility, but a commercial sector will undertake a project that is profitable and part of it is paid or is given as corporate social responsibility. So we need to understand in public sector, it is more of profit or provision of responsibility to the society than making profit for the shareholders. So those are the things that we need to look at. I give a small example here of corporate social responsibility. KPMG purchased 90% electricity from renewable sources. They purchase to benefit the society. The negative, company using subcontractors engaging in child labor. A company can engage what we call the cheap labor at the expense of the workers, but they make more profit. They take advantage of the people. They provide some service to create employment to the society because they are disadvantaged. They end up portraying themselves as corporate social responsibility, but they are taking advantage of the society. Then when you talk of the corporate social responsibility is the implementation method. We included in mission statement and the strategic plan. We have the corporate social responsibility champions in the organization. We have key performance indicators, the KPIs, that will help them achieve corporate social responsibility. They got the committees and policies for corporate social responsibility to enable them involve or engage or achieve corporate social responsibility. For the government, it is very easy because everything is directed towards that. Then the last thing that I would want to mention under that, it is the corporate social responsibility argument against. As much as we look at corporate social responsibility, we need to look at what are the don'ts in corporate social responsibility. What is that we would feel it is against the corporate social responsibility? The shareholders look at the profitability and returns. Out of that, they neglect that what is the welfare to the government, to the society. And the worst is where the shareholders do creative accounting so as to minimize the taxable profit. And you know that the tax we pay goes to the government and the government help the public. So the worst of it is where you fail to pay tax because that tax helps the government to achieve the objective of the society. The other part is where the shareholders feel we will not give the society. You give the employee the rest of the salary so as to maintain them. You give to the society nothing so as to maximize on the shareholders' wealth. So there is always a conflict between the shareholders' wealth maximization and the profit, the corporate social responsibility. And I think to that point, I have finished the first part and what I would have wanted to explain, but I want to take you to a very important and a very critical part. And this part, I will be explaining the foundation of finance. Today, I decided to give theory, complete theory, and a lot of theory, so that when we come to the computation, I'll be referring a lot to this. So please make sure that you understand everything that I explained today, and I will give a lot of theory. Then I will be referring to it. So allow me to check if there is a question so far. Let me see, is there a question? Now, if there isn't, I want to take you to a very important factor in our introduction. Let me change my slide. Let me change my display. Is my screen visible? Hello? Let me know whether my screen is visible. I can see that everyone is still on board. Thank you for staying there. I want to ask whether my screen is still visible. As I check whether there is a question, a comment, or something. Yes, it is visible. Thank you. I hope there is no one who is asleep. Everyone should be concentrating. It is 5 minutes to 8. Rwandan time, it is 5 minutes to 9. Kenyan time. So we have about 1 hour remaining. I will explain the next part. And one thing I want to say, today a lot of theory. Today a lot of theory. From next lesson, we will now engage into computation, and that's what I feel that we will now have gotten into the real business of corporate finance. But remember, all this theory is examinable. From what you can see on my screen, I want to take you to this part. I'm going by the syllabus. So what I have is what we call the efficient market hypothesis. We are required to look at that as a part of introduction before we get to now the other things. When you talk of the market hypothesis, market theory, efficient market hypothesis, the market theory, we need to ask ourselves, what is it? When we talk of the corporate finance, we deal with the investments. We deal with the value to the shareholders under the objective. But again, we grow our view to incorporate or capture the companies that are listed into the Securities Exchange. The Rwanda Securities Exchange, if I am correct, I want to tell you how many companies are listed in the Rwanda Securities Exchange. Oh, my screen is not displaying. Can you confirm that my screen is displaying, please, before I ask the question, or what is the problem? Is my screen displaying? Someone to respond. Okay. is something that I lost. Let me know whether the screen is displaying. Some yes, some no. Can I have? Yes, it is displaying. Some says yes, some says no. I can see yes. It is visible. Okay. Yeah, okay, fine. Thank you. Thank you for that. Please, in case it is not displaying, you can check on your end. In case it failed to display, please unmute and tell me. Unmute and let me know, because I may continue explaining something that is not visible. I wanted to ask a question before I get to the issue of the market hypothesis. I believe the Rwanda market is called Rwanda Securities Exchange. Don't tell me that it is called Rwanda Stock Exchange. Stock exchange is an old school. If it has not changed, it should change. We no longer deal with the stocks only in the market. We deal with the securities. So we talk of London Stock Exchange, New York, London Securities Exchange, New York Securities Exchange, Nairobi Securities Exchange, Rwanda Securities Exchange. My question is, how many companies are listed in the Rwanda Securities Exchange? How many companies are listed in the Rwanda Securities Exchange? Someone to write for me. Someone to let me know. Rwanda Securities Exchange. For those who know it as Rwanda Stock Exchange, how many companies are listed? I'm waiting for your response. I should be dealing with the accountants, the people who have the information about the country's securities exchange, because I'll be explaining a lot on the securities exchange or the stock exchange, if we may call it that. How many companies are listed in the Rwanda Securities Exchange, please? I haven't seen any response. I have not seen any response. Rwanda Securities Exchange, someone says 10, 10, 10. So I can see 10. So there are 10 companies listed in the Rwanda Securities Exchange. Nairobi Securities Exchange has 68 companies listed in the Nairobi Securities Exchange. It is a little bigger, but again, we need to consider a number of factors. The economy, the Kenyan economy is bigger, so we could have that. So we are saying that about 10 companies are listed in the Rwanda Securities Exchange. Someone says 9. They could be approximately there. That is something that can be confirmed. But the bottom line is, there is, in Rwanda, there is a securities exchange. And the reason I say that, Rwanda is lucky to be one of the countries that when we are talking of the securities exchange, there it is there. When you are in Kenya, it is there. You'd be surprised that so many countries, there are no securities exchange. There is nothing like the stock market. There is nothing like securities exchange. They read theory that they cannot do anything from their country. So Rwanda is lucky, Kenya is lucky that we are grown to have securities exchange in our economies. Now, I want to give this. In a securities exchange, the market prices change from time to time. This change in market prices is triggered by some factors. Now, what we are interested here is the efficiency of a securities market. That's why we are talking of efficiency market hypothesis. We got so many markets. There is do I remember that market in Kigali? I think I have forgotten, where you buy and sell the African the Rwanda or African attires. I cannot remember the name of that market. There is a market like that one. There is the stock market or the securities market. There is the money market. We have derivatives market. So there are so many markets. And what we are looking at from this perspective is the market that relate with corporate finance, financial markets, derivative markets, the securities market. You see, those are the things that we are talking about. But I will narrow it down to the securities market. In a security market, we say that a security market could be efficient or inefficient. What determines the efficiency of a securities market? That is the question. What determines the efficiency of a market? A market or a securities market is a market where securities are traded. You can walk to your broker today, instruct them to buy security or shares in the Bank of Kigali. I will assume that Bank of Kigali is listed. You could be having the securities and you tell them, sell them off. The issue of the pricing should be efficient, that you cannot predetermine with accuracy the price of the security. In simple terms, we are saying that the price of a security in the market is determined by the forces of demand and supply. And what informs the demand and supply in the market? It is the market's ability to process information. Let me give an example. In year 2020, the world was hit by COVID-19. Kenya, America, China, Rwanda, everywhere we had an issue of COVID-19. The trading in the market went down. The trading or the trading activities went down. Some countries were more hit. So people felt that based on the information we have, we may have some of the companies go down. So what do? Let us sell off our shares in those companies. When you go to sell off, the supply of the shares go up while the demand is low. What happened to the price? The price go down. Let me give a real example. If today one of the CEOs in the big companies that are listed in the Rwanda Stock Exchange decided, I will resign, they call the media briefing, they say that I am resigning from this company because I have noted a lot of irregularities that are beyond my control. And as a result, I have decided to resign. The following day, people will be in the market to disassociate themselves with that company. They start selling the shares. That is information processing. The information that is released by the CEO is negative, and it is immediately incorporated in the share price. If there is political instability in the country, investors will feel that country is not safe to invest in. So what will the investor do? They process that information, or that information is processed in the market, and the investor starts selling off the shares. They make the demand for the share to go down and the supply to go up. Now, when we talk of the efficiency, how do we say that the market is efficient? Number one, if it has an allocative efficiency. An allocative efficiency is when investments are made in that firm, returns are realized. So there is a relationship between the return and the investment. What does this mean? If today a company has proven that if they invested, the wealth increases, they give in their strategic plan that in the next 5 years, we are going to make investment A, B, C, D. And we have the budget and the plan to do that. The shareholders in their wisdom will feel that they need to go and invest in that company because there is a relationship between investment and profitability, investment and returns, wealth creation. So that relationship should be reflected in the value of the share. If a company is associated with investing and not creating value, shareholders will associate themselves with such a company. They start selling the shares. The share prices will go down. Operational efficiency. The operational efficiency is when you are dealing in the market. Let's say you want to buy shares in the market, the cost that you incur in transacting is so insignificant that it doesn't influence your decision. If today I walked to the Nairobi Securities Exchange and I want to invest 1 million shillings by buying shares in the companies that are listed in Rwanda Securities Exchange, in the Nairobi Securities Exchange, and I'm told that when you are buying the shares, 10% of your money will go to the cost. 10% of 1 million is 100,000. I will ask myself, is it worth incurring all that cost to invest? I will not invest. So it means that inefficiency discourages me, demotivates an investor from investing in the market. As a result, the demand of the security will go down, and with the low demand, the prices will go down. So the market absorbs the operational efficiency in the market. Information efficiency. The information efficiency, it is the ability of the market, and I want you to know this, to fully, accurately, and instantaneously incorporate the information released in the market and which is relevant to the pricing of a security. For example, if today one of the company listed in Rwanda Securities Exchange in an AGM, the CEO reports that the company has reported a growth of 20% in the last 1 year, and we expect this growth to continue in the next 1 year. That information alone is enough to make investors the following day to go to the market to buy shares. That information will be fully, accurately, and instantaneously processed in determining the price of a share. As I said, if the manager or not the manager, if the CEO of a company decided that I have resigned, there are people who will make immediate decision to go and sell off. Information processing efficiency. The information that is released in the market is incorporated in the price of the securities. Now, the next thing that I want us to look at, under the efficiency of the market, is the form of information efficiency. This is another thing that we need to look at and understand. And I will explain this. We call them the forms stroke levels. Stroke levels. We can call them the degree. In some cases, they are called the degrees. The forms, levels, degree of information efficiency. I want to explain this point because as long as you are a student of finance, it is a basic thing that you need to understand. What is the meaning of the level of market efficiency? But before I explain that, I want to ask whether someone has a question. Yes, I check whether someone has posted a question. So I cannot see any question that is posted. If you have one, you can post. Let me explain this part of the market efficiency. There are 3 levels, there are 3 degrees, there are 3 forms of market efficiency. Number 1, weak form efficiency, semi-strong form efficiency, and the strong form efficiency. I will put them in the order that they are given. Number 1, weak form efficiency. I said that the information about the security is accurately, instantaneously, and fully incorporated in the security price. What is this information? In a weak form efficiency, this is where we make our decision based on historical information. Based on historical information. I'm not very sure how old is Rwanda Stock Exchange or the Rwanda Securities Exchange, but I can give you an example from the Kenyan perspective. Today, we have some old people at their 70s, 80s, who will tell you that when I was young, we used to put our money in Kenya breweries. Kenya breweries is today the East African breweries. So they will tell you, now that I have retired, I will go and buy shares in Kenya breweries. But actually they mean East African breweries. Why? Because historically, they have known East African breweries as a profitable company. So they are using the information they knew in the past about that company, and it is the one that they are using to make the decision. It is a weak form efficiency. You see, this person is fully using the historical information to invest in that company. Fully. Someone will say, oh, I cannot invest in a company X because in 1980, in 1990, that company was involved in a scandal and people lost money. That person is using historical information. We say that as much as that information is accurately incorporated in making decision, it is weak. It is at a level, at a weak level, at a weak degree, use of historical information in making the decision about investment. The next one is semi-strong form efficiency. The price of the security is based on the current information and the historical information. Someone will say, I want to invest in the Bank of Kigali because in 1990, that bank was the biggest bank in Rwanda. And today, in the year just ended, the Bank of Kigali reported the highest profit in Rwanda. So I will buy shares in this bank because it used to be the biggest bank, and today it has just reported the highest profit. So what are we saying? We are making the decision not based on the information we have about the Bank of Kigali in year 2000, but also the current performance of this bank. We say that this information is semi-strong. It incorporates the historical information and the information today in making the decision. So we are making the decision using historical and present information. This management has just announced, has just undertaken an acquisition of another investment. So because they have undertaken, I will go and invest. We talk of the historical and the today's information. I don't know whether we are together. I want someone to ask a question. Ask a question that far. So if there is a question, I cannot see any question. Oh, okay. Someone is asking what is about TA for semi-strong. Can you make me understand what is there? TA, please, so that I can respond to the right question. Oh, technical analysis. Okay. I will mention that one. Okay, but I can go to that. But I can give an overview on that. But that one is more on the determining the price of a security. The technical analysis, the chartist analysis. Let me put it this way. The issue of the chartist is more on predicting the price of a security. More of predicting the price of a security. In the predicting the price of a security, we can use charts. We can use graphs. That is what we call the chartist analysis. The use of the graphs to help us in predicting the price of a security. So when it comes to the chartist, we brought the graph of the history of the data in the past that will help us to predict the future. I think that was the question. Technical analysis, the chartist analysis. The alternative to the chartist analysis is what we call the random walk hypothesis. The random walk hypothesis. The random walk hypothesis means the price of a security is determined by the information that is released in the market. So we can use the charts to predict the price of a security, but in a modern world, we use what we call the random walk hypothesis. The information released in the market help to make the decision. For example, a company may be performing so well, so if you plot a graph, it shows an upward trajectory, but it is involved in a scandal that has not been there in the past. What will happen? People will start selling the shares of that company. That is information, the random walk, the immediate. And this is more of the efficient market hypothesis. The efficiency of the market is the one that absorbs the information other than using the chartist. So I think that question is well answered. The chartist is about what we are talking about, the presentation of a graph. If you are satisfied with that answer, you can let me know. Go back the allocative efficiency. Let me mention that part of the allocative efficiency, as someone is asking that. You will always excuse me if I don't read your name. I can see this one is from Joshua. The other one was from Emmanuel. Yeah. So the question is the allocative efficiency. If you are a shareholder, okay, let me give an example of a class so that you can understand the allocative. Assuming I was engaged as a UR lecturer to teach corporate finance, I take you through the whole 56 hours. You go sit in the exam, nobody passes. I get another semester, I teach you, nobody passes. Do you think there is anyone who will be ready to attend my third semester? There isn't. If I was given corporate finance to teach you, I teach the first semester, we record 90% pass rate. I teach the second semester, we record 100% pass rate. Everybody in the third semester will be asking, who is teaching corporate finance? Because the news will have spread that if you are taught by so and so, you will pass. It is the same case with what we'll call the allocative efficiency. A CEO or a company will tell shareholders that we want to borrow 1 billion Rwandan francs to undertake a project. And in 5 years' time, you will see the result. They go borrow, they invest, they even tell the shareholders that we are not paying the dividend during this period. Year 1, year 2, year 3, year 4, year 5. By the end of year 5, the CEO called you in a meeting. We made huge profits. And this is how it is. So what do? You associate yourself with that company as the one when they allocate resources, there is return. What are you likely to do is to go buy the shares in that company because you know that there is value for your investment. The share prices will go up. But if the reverse is true, everybody will associate with that company. They will not be ready to invest. They will be selling their shares to run away from that company the moment they hear that we are not paying dividend, we want to invest. They will disassociate. the company shares will go down because there is no relationship between the investment and the return, creation of the wealth. Someone is talking about the operational efficiency. Is asking about operational efficiency. Okay, I want to give an example outside, then I take you back. Today, when you are paid your salary by your employer, you go to the bank. Let me say that your employer pays you 1 million Rwandan francs. You go to your bank, you withdraw the money, or you transfer to your landlord, you transfer to you withdraw some money for your use, you transfer them to your mobile money, you take some money you pay to the school fees, your school fees or the school fees of your kids, you send to your relatives. When you are doing all that, do you consider how much is the transaction cost? In most cases, if I ask you, and if you are honest with me, you don't consider how much they charge you. Why? Because the money they charge is negligible compared to the amount of money that you are transacting. Maybe by the time that you are transacting, you are 1 million, maybe the much money that you'll have spent in the whole transaction, maybe it is 50,000. 50,000 is about how much? No, that is too much. Or let me put it that way. It's 50,000, which I can take as, no, that is too much. Let me take 25,000. That is the much money that you'll have spent. Because of, but that depends on the many transactions that you did. If you did 1-2 transactions, the amount will be less. So it is inconsequential in your decision. Otherwise, you would say, hey, this bank is taking too much of my money. Let me keep my money at home. I don't want to bank with them. But because the money is insignificant, you go and buy, you go and withdraw, you continue banking with that financial institution. It is the same case when you are operating in Kenya, we call it a CDS account. When I call my broker and tell them, or I write an email and tell them, I want you to buy me the Kenya Commercial Bank shares tomorrow worth 2 million Kenya shillings. They do it, they charge me 1,000 shillings. 1,000 shillings is insignificant on 1 million. That is not something that I should think about. It is insignificant. It doesn't influence my decision in trading. But if it were significant, we say that the operation cost is inefficient. The operating efficiency makes sure that the cost of trading or transacting is insignificant, that it doesn't influence my decision of buying and selling security. I can do it daily, buy, sell, buy, sell, buy, sell, because the cost is insignificant. I hope that question is answered. Is there any other question? Is it possible to predict stock prices and a weak form of efficiency? How? That's a good question someone is asking. Is it possible to use the historical information? Yes, it is, but the efficiency is weak. And why do I say that? Someone has information about the performance of a certain listed company in the past. So what they will do in a random walk hypothesis, they will say that I know this bank is good. Let me go and buy the shares because I know the share prices will go up. Why? Historically, share prices increases. This company is known for making profits. So let me go and invest in it because when I was a shareholder in year 2015, we used to earn a lot of dividend. Let me go and invest in it. So it means you are using that information to predict the direction of the share. the share prices will go up. So it is a weak approach. It is not the best. But if it is the only alternative, you can go for it. So we can say yes, but it is a weak, it is not the right decision. So the issue of how it is about using that historical trend to predict the likely future trend. It may not be accurate because the approach is weak. When I see you asking questions, I feel encouraged. Thank you for asking questions. And we are moving on well. If you allow me, I believe I explained the strong form efficiency. Let me explain the strong form efficiency. It is a combination of the historical, the current, and the future information about a company that drives an investor in making investment decisions. And I want to explain this in a way you understand. Today, where I stand, if I want to invest in Kigali, I want to buy shares in Rwanda Stock Exchange, Rwanda Securities Exchange. I will check the company that I want to invest in. How has it performed in the past? In year 2015, this was the average share price. This is what was the profit. This is the investment that we have made. I look at that. Today, what project is this bank undertaking? The CEO, they have just appointed a new CEO, and this CEO came from one of the best performing entities in East Africa. So what? They have a good CEO. They have a CEO who is known to perform. I am making decision on who is the CEO today. What project are they undertaking today? What is the profitability performance today? Plus the history. Then I will ask myself, from the strategic plan of this organization, what are they planning to do in the future? Strategic plan, they are planning to expand their business to Kenya, Uganda, Sudan, Tanzania. They have already started investing in Tanzania. So they are likely to go in the next 1 year, invest in Kenya, invest in Uganda. So they are growing. That is what has not been done. It is future information, the information that is available about the future. So I want you to understand it from this perspective. A strong form efficiency is where the security price accurately, instantaneously, and fully incorporate historical, current, and future information that is relevant in security prices. It is about past, present, and the future. If you are making the decision on that, your decision making is efficient because you have incorporated historical information, present information, and the future information. If we could go by that, we are headed for good decision making. I don't know whether about the efficiency there is a question. I want to check whether there is a question before I get to the next part. Okay, I think we had asked most of the questions. Yeah, so let me get to the other part of it. The implication of the efficient market hypothesis for financial decision making. The efficient market hypothesis is derived from what we call random walk hypothesis. Random walk hypothesis is information is released, I make a decision. Efficient market hypothesis is about all the information available is incorporated in market decision making. So what is the implication of efficient market hypothesis for financial decision makers? Number one, timing of the financial policy. We need to ask ourselves, when do I make the investment decision? Based on when is the information released, the timing. If the company reported that we have paid the dividends, you are in an AGM and you are told that every shareholder, check your bank account, the dividend has been paid. Even if you buy those shares, you will not benefit from the dividends. But if you are in an AGM and the company declare that we will be paying dividend in the next 3 months, and remember the dividends are paid to the holder at the time of payment. If you buy those shares, you will benefit from the dividends. So the issue is when the information is released and when do you make the decision? The timing of financial policy. When is the right time for the company to release the information, and when is the right time for the decision maker to invest? 2, project evaluation based on the net present value. The project evaluation, at this point, I will go by what will be tested. But in the modern world, allow me to mention this, but I'll not go into details because I don't want to confuse you out of the exam. In the modern world, we do not use the NPV. We use what we call the extended net present value. I will not take you to the extended net present value because it may not be examined. And again, but when we meet there in the corporate world, I'll show you how to go about the extended NPV. It is more realistic than the net present value, but the net present value is what is within our scope. Now, when we talk of the project evaluation based on the NPV, we say that a decision maker should look at the viability of the project that is being undertaken by the entity, and as a result, that will influence the value of the security. The determination of the value of the security may be based on the present value of the expected benefits from that security. Look at the NPV from 2 perspectives. Perspective number 1, the company undertake projects, evaluate them using the NPV, they generate a positive NPV. That is enough to make you, as an investor, buy the securities. If the project being undertaken will generate negative NPV, that is enough to help you make a decision to sell your security or even not to buy the security. That is from one perspective of the NPV. The second perspective is you as an investor evaluate the securities using the NPV. Ask yourself, if I invested 100,000 Rwandan francs in buying these shares for 5 years, I will sell them at the end of the 5th year at how much? And how much dividend and interest will I have generated? From that perspective, you will determine whether your investment is generating a positive or a negative NPV. So the NPV, we look at it from evaluation in 2 perspectives: the company investment and our own investment. The other thing that needs to be considered in efficient market hypothesis is, are the financials presented by the entity manipulated to influence our decision making? You as an investor, it is your duty to ask yourself, do they portray a true and fair view or they are manipulated. An entity will consider whether the financial statements are true. How do we evaluate that? One is due diligence from relying on the information, the audited financial statement by the auditor, that is number one, and checking, is there a scenario where this entity has ever been involved in creative accounting? So that again, it is not every financial statement that is presented to you which you should rely on. You should also consider whether the financial statements are a reflection of the true and fair view of the entity to avoid creative accounting. So that is the other thing that needs to be considered. The other thing is the merger and takeover. Now, when it comes to the issue of the merger and takeover, our next topic is merger and takeover, and which merger and acquisition, which will involve a lot of computation. In this perspective, you need to ask yourself, because the company is merging, is there a synergetic gain? Are there gains that are coming? In merger and acquisition, we'll be looking at the benefit to the predator. Predator is the person, is the firm acquiring, and the target is the firm being acquired. So we ask ourselves, is there a value creation from the predator? Is there a value creation from the target? So it is good to ask yourself, when we, in case of merger and acquisition, is there a positive NPV? Are there synergetic gains? If they are, then that information is good and it should help us in making investment. The other thing is the validity of the current market prices. You need to look at the market and ask you as a finance personnel and ask yourself, the information that you are getting in the market, how varied is it? Because sometimes we get information that is skewed to favor some quarters, and information that leads to undervaluation, overvaluation, or the correct valuation of security. So the undervaluation, we always say that. Okay, before I say that, let me ask you a question. If you want to invest in the market, do you buy a security that is undervalued or overvalued? That is the last thing that I'll be explaining today. When you want to buy securities in the market, do you buy a security that is undervalued or overvalued? Please answer that in the chat box. Do you buy, would you advise someone to buy an overvalued or undervalued security? As we wind up. So let us see the response that we've had. Do we invest in undervalued security? Someone says undervalued. Someone is okay. Someone is asking a question. We buy undervalued securities, undervalued securities, undervalued securities. Perfectly correct. Someone asked a question. The implications of efficient market hypothesis. Where was this? The implication of efficient market hypothesis are not clear. I will get back to that. Undervalued, 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 perfect. Good. I think everyone understands, and that shows that we are moving well. Is there a question? Yeah. So I think the only question that there is someone says that the implication of efficient market hypothesis are not clear. I will respond to that, but let me first explain this last part. The validity of the current market price is about when you are making investment decision, ask yourself, are the security undervalued, correctly valued, or they are undervalued, correctly valued, or overvalued? We invest in securities that are undervalued by the forces of demand and supply in the market. Undervaluation means that a security is costing 1,000 Rwandan francs, but its intrinsic, its true value is 1,200. If you bought that security at 1,000, it is likely to increase to 1,200. You will gain. So that is why we invest in undervalued. Overvalued means that a security is selling at 1,500 Rwandan francs, while its true value is 1,200. If you invest in overvalued security, you are likely to lose. Someone is asking about the implications of the efficient market hypothesis for financial decision. When the securities are efficiently valued in the market, you are supposed to make the decision based on the efficiency. Timing. If you do a long timing, then you are not efficient, if I can put it that way. If you do the right timing, you are making an efficient decision. I can simplify it that way. Project evaluation. If you do a long evaluation, or if you invest where a company is investing in project generating negative NPV, then are you efficient in your decision making? You are not. If you invested in a company that has presented account records that are presented through creative accounts, then you are not efficient. You need to be efficient to make sure that you invest in the correct financial statements that are correct, free of creative accounting. Make investment efficiently, knowing that the merger and acquisition and takeover is resulting to gain to the firm. But if you are only given the information, merger and acquisition, you go and invest, and yet there is no benefit, then your information is not efficient. You are making a decision on inefficient information. The validity of the current market. You decide to invest in overvalued security. Is the efficiency of the market helping you? It is not helping you. So the validity, invest with the correct information that will lead to efficiency. Invest in undervalued security. And I think with that, I have exhausted that what I wanted. Tomorrow we are meeting again, and today was just laying the foundation for what we'll be doing, and I hope it is fruitful, it is beneficial to all of us. So I want us to leave it at that, unless there is an immediate question that needs to be addressed. We have done justice to today. Any question? So if there is no questions, someone is asking that you haven't seen the updated timetable. Yeah, I know the timetable will be sent, will be shared from the institute. It will be shared. What other question? I tend to believe the same link will be used tomorrow unless otherwise stated, but the institute will communicate. Keep always checking your emails. Someone is asking about the material. I will share the material. Yeah, the material will be shared. The implication. Yeah, I think that is the questions that are there. Thank you so much. Thank you so much to everyone. Yeah. So thank you so much. Have a great evening. Have a great evening. Let us meet tomorrow. We shall continue from there. And please, let's deal with what is there for tomorrow. We are not having a lesson on Sunday. It is tomorrow. Tomorrow, Friday. Tomorrow, Friday. Tomorrow, Friday, that is when the class, the same time. Thank you so much. Have a great evening. Have a good night. See you tomorrow.